If you've seen my videos, you know that I'm a fan of analyzing whether you should or should not do a Roth conversion. But today's video is much more than math. If you're watching this and you're within 5 years of retirement, or maybe you've just retired and you're thinking about how do I make these decisions, this video is for you. So today, the thesis is simple. It's basically, even though lifetime tax paid is often the goal of doing sizable or strategic Roth conversions, I'm making the argument that a bigger goal is when those taxes are paid and when the break even on those taxes paid makes sense for your plan. For example, in retirement, I always talk through what are your goals when you retire. For most people, that's going to be travel. You've heard it said there's the go-go years. They mean something for a reason. They are very, very important. And some people would not trade Roth conversions for the go-go years. I want to just show you a very simple example of a client couple that has roughly $2.5 million and how they made a decision to do or not do a Roth conversion and to what degree, because they want to utilize those go-go years. So if that's something you're thinking about, then this video is for you. My name is Forrest Dutton. I am a certified financial planner. I am the owner of Brightworks Financial Planning. I love doing these videos. I help people retire with confidence. So that is the goal of this video. Hope you enjoy it. This video should not be taken as personal financial, tax, or investment advice. It's just for education, and without further ado, on to the rest. Okay, let's talk through this case. We're going to talk about Bill and Jane. Now, I often do videos on early retirement, and this one is going to fast forward a little bit. So Bill and Jane are a little bit further along, and they retired, and they actually are both taking Social Security. So what I want you to see here is they have a short window, a 5-year window, basically between the years of 67 and 72. And what they're going to do is, during that time, they're trying to determine, should we convert this money that we have? Now, what is the breakdown of their assets? So in this case, we just have a large traditional IRA. Again, it's tax deferred. They're trying to figure out, should we convert this money, and if so, how much? They also have a joint account at $100,000. Another relevant detail in this case is not all joint accounts are created equal. This happened to be an inheritance type account, so it doesn't have that much gain in it, meaning the cost basis is $90,000, so it's very efficient in terms of them taking money out if they wanted to pay taxes for conversions. So that's an important detail. They have a little bit of emergency money in the bank. Now, let's go forward and say, now, for most people, if you were to think about what would be the best situation to convert this money, we need a little bit more information. So the first one is, how much do they want to live on? In this case, for Bill and Jane, they actually are living below their means, their needs. They have Social Security that covers them at $4,500. That's pretty much what they need for their month-to-month, besides a little bit of supplement from their taxable account for things like travel and additional healthcare expense. So in this case, there's really not a lot more that they need this retirement account for. Now, that being the case, that they are at age 67, the window is closing, they're going to have to take required minimum distributions from this account by age 73. So what I'm going to walk you through here is just two very simple decisions. One, if you look at the longevity and lifetime tax, should you do large conversions? And if so, what does that actually do to your plan? And maybe should you consider a more modest conversion, and what would be the argument for that? So let's start with the larger conversion. So what I'm going to show you here is, again, we can look at this strategy of converting up until the 32% bracket. I'm going to show you that first. So what we're going to do here is, this is modeling converting the money up to the 32% bracket. So we're filling that up, and we're starting currently, and we're going to end at the end of the year when Bill is 72, so before required minimum distributions. So what you see on the screen here, I'll hover over it, is you see the different tax brackets. Now, as you can see there, basically they're filling up the 32 up to the 32% tax bracket, right? So we're going up until that level and stopping. So we don't want to go over 32%. And what happens there is you have a 5-year period where we are paying 6 figures in taxes. Now, this is talking about what their income is, but I'm going to change this in a second. I just want you to see the visual. So, essentially, what we're doing is we're taking a lifetime of tax liability and we are eating it up front 1, 2, 3, 4, 5 years. Now, if I hover over this, what you're seeing now is their taxable income for the rest of their life, which is pretty much zero. So this would be I would call the nuclear option. Now this takes a lot. These are very sizable conversions. So if you look at these 5 years, to do that, we're talking about high 6-figure conversions, 1, 2, 3, 4, 5, starting at 485,000 and never going below about 350,000. Now, that being said, the argument for that would be, well, what would be the taxes paid? So what I want to show you, and this is the main point I want to show you in this video, is oftentimes when it comes to decisions around tax and even around investments, we sometimes we think about break-even points, and I want you to think about this. Even though this lifetime tax, what this is saying is that if you do this strategy, you will pay over $342,000 less in taxes. Another way to say that would be you would save that much in lifetime taxes. It matters when you pay them and when you get them. So I will look at this and talk through the break-even for you, because to me, this is the break-even that most people do not discuss. Meaning, it doesn't necessarily matter if you paid less lifetime tax. It might matter more when you pay it because of your goals. So if we look at the first 5 years, 3, 4, 5. Again, these are tax bills, okay? So 119, 122, 125, 129. So adding all that up, you were paying $619,000 in upfront taxes, okay? Which may or may not be the right decision. So what I want you to see here, though, is how long would it actually take you to break even on those $619,000 of taxes that you paid with this very, very large Roth conversion? Answer, adding all this, I did the math so you don't have to. So looking at these strategies, we'd have to go all the way out to age 90. Now again, you may have longevity in your family, you may know that you're going to live a long time, or maybe have a feeling that you're in good health, but in reality, we don't know. So what's really hard to show here and hard to stomach is making such a large conversion early on and paying such high taxes, when the alternative is, remember, reference strategy means we do no Roth conversions. You basically pay zero up front, and many would argue between 67 and 72 or 73 is a golden time to do things like spend time with your grandkids, do an extra trip, go out with friends, travel wherever you want to travel. So the point I'm trying to make here is the math is one thing, but life is another. And so the fact that you have to pay all of this during this time where your window is closing makes this a less attractive option in my mind, even if you do pay $342,000 less in taxes. Because remember, where does that $342,000 come from? Well, it comes from age 90, and in this case to 95. So you could argue and say, well, if I had to pay taxes during that time, does it really matter? Meaning, what is my lifestyle actually going to look like? Chances are you'll probably live on less. Chances are you won't be traveling, so your income is going to be lower. If you have extra money in your tax deferred account at that time, you could probably just use qualified charitable distributions or give to charities. So there are ways that you can mitigate that tax bill. Doesn't mean that someone shouldn't decide to do this. Remember, this is not specific advice. You have to get with a financial planner and run these numbers for yourself. I just wanted to show you that. And then I wanted to show you maybe the argument for maybe a little bit more of a modest decision, especially when it comes to how often you recoup that decision, meaning when would the break even be? And many people have done research around this for other strategies in financial planning. The biggest one being Social Security. The break even for most people is usually somewhere between 78 and 80 years old. So that's a little easier to stomach for most people, meaning the math makes sense for you to wait until age 70 as long as you live that long. So in this case, to me, there's an argument to be had for longevity and Roth conversions. And this doesn't even bring in the nuance of what if there's one spouse left behind. I'm fully aware that tax rates would change, and that does change the impetus of some of this conversation. I just want to frame this in terms of goals. So instead of maybe filling up the 32%, what if you did something that would be considered more of a slam dunk, such as what if you just filled up the 12% bracket? Again, we're doing conversions between age 67 and 72. So I would say this is a more modest path, okay? So again, you can see we're not really, this is the taxable income with conversion. This is without conversion. So really the play here would be, if you're not sure, right, you know that you're at least going to, you're at least wanting some tax-free income, maybe to leave to your heirs, but you also want to be able to live along the way. This would be more of a wait and see approach, meaning you're not sold that you need to do large conversions, but you also like the idea of taking advantage of some laws later, especially if you are 65 and older in this case. And the reason this may make sense is, remember, these are much more modest. Okay, so we're barely making it to 100,000. In most years, we're doing 95,000 a year in this situation. But what also matters is, again, the point of this, the whole point of this. When would you hit the break even? Okay, so I did the math again. Over 5 years, you would pay just under $66,000 in tax, whereas the other strategy, you would not be paying any tax. So how long would the difference between these tax numbers actually get you to a break even? The answer is 82, much more reasonable. Now, the other thing is, this is still a viable path to have meaningful money that is tax-free, right? Whether it's later in your retirement or whether it is something you want to leave behind. So again, it's not that this has to be all or nothing. That's the point of the video. And I also wanted to say that when you're considering Roth conversions like this, really think about that time period, right? So not just when the taxes were paid, but when they're recouped in terms of break even, and also maybe the opportunity cost of what you missed along the way. So I hope this was helpful, and if you like this content, please subscribe, please like. I would actually love to know what you think, because in my opinion, there's usually an extreme version of Roth conversions that is being predicated in many videos, but I take more of a moderate, pragmatic approach. I don't necessarily think that everyone has to do that. So I would love to know what you think. What does your strategy look like? So again, please like, subscribe, have other videos that go over these concepts in detail. And if you like this kind of content, please let me know what you'd like to see, and I will see you on the next video.